I'm sure you've heard the news. August 5th, 2024. The Nikkei 225 index plummeted 12.4%. It exposed a hidden vulnerability. The yen carry trade. Imagine a financial game of Jenga, balanced on cheap yen. On that day, the tower wobbled, threatening to topple. The yen carry trade is a complex financial strategy, borrowing yen at ultra-low rates to invest in higher-yielding assets worldwide. Japan's low interest rates make the yen the go-to currency for this strategy, fueling a massive influx of capital into global markets. The yen carry trade exploits interest rate differences. Borrow yen at low rates, invest in higher-yield assets. Japan's ultra-low rates make it ideal, but exchange rate fluctuations pose risks. To truly grasp the magnitude of the yen carry trade, one must delve into Japan's prolonged period of low interest rates. Following the burst of Japan's asset bubble in the early 1990s, the country entered a period of economic stagnation known as the Lost Decade. The Bank of Japan slashed interest rates to near zero. This made borrowing yen incredibly cheap, incentivizing investors to seek higher returns elsewhere. Japan became a prime source of funding for carry trades. The yen carry trade, worth over $4 trillion, impacts global financial systems. Fueled by cheap yen, it permeates asset classes worldwide. The yen carry trade is crucial for global financial stability. The seeds of the yen carry trade were sown in the ashes of World War II. Japan embraced export-led growth, keeping its currency weak. Japan's low interest rates attracted investors. The 1990s and early 2000s saw the yen carry trade take flight. The collapse of the Soviet Union and rise of globalization ushered in economic integration. Emerging markets offered higher potential returns. The Bank of Japan kept interest rates near zero, making the yen carry trade appealing. The trade depressed the yen's value, boosting Japanese exports. The global financial crisis of 2008, triggered by the collapse of the US housing market, sent shockwaves through the global financial system, testing the resilience of the yen carry trade. The yen carry trade began to unwind. The yen appreciated sharply, squeezing those who had borrowed yen. Fast forward to June 2023. The global economy faced soaring inflation. Amid this, Japan's market surged. The Nikkei 225 index posted a remarkable return. The yen remained weak against the US dollar. This highlighted the yen carry trade's power. The euphoria of June 2023 was short-lived. August 2024 exposed the vulnerabilities of the yen carry trade. The Nikkei index plunged 12.4%, its largest drop since 1995. The yen's ascent, a currency's revenge. In August 2024, the yen's dramatic appreciation caused market turmoil. Rising US inflation drove this shift. Investors fled to safe haven assets like the yen. The Bank of Japan's policy bolstered the yen's status. Section 4. Closing the gap. Interest rates and the unwinding yen carry trade. The unwinding of the yen carry trade was influenced by a shift in the interest rate differential. By 2024, it had narrowed to 285 basis points, eroding profitability. This led to a significant unwinding of the yen carry trade. Section 1. The domino effect. How a currency shift topples a global trade. Imagine a line of dominoes stretching across the globe, each representing a piece of the yen carry trade. When the yen was cheap and predictable, a gentle nudge could send those dominoes toppling in a satisfying, profitable cascade. But when the yen suddenly surges, the dominoes fall in reverse, unleashing chaos instead of profit. Investors who once borrowed cheap yen to buy assets suddenly find themselves squeezed. The yen they borrowed is now more expensive to repay, eating into their profits. Fire sale. Liquidating assets under pressure. Imagine trying to sell your house after a major earthquake. Everyone's selling, buyers are scarce, and prices plummet. That's the yen carry trade unwinding. Coveted assets become toxic, driving prices down. Large institutions get caught, magnifying losses. A currency fluctuation in Tokyo can trigger global selling. Section 3. From Tokyo to Tech. The global reach of the unwinding. The yen carry trade's unwinding ripples through global asset classes and economies. Like a stone in a pond, its impact spreads far and wide. Section 4. A game of leverage. Magnifying profits and losses. Leverage amplifies potential returns. It magnifies profits and magnifies losses. A double-edged sword. Use wisely. The unwinding of the yen carry trade has ignited fears of a global margin call. Imagine a cascade of demands for more collateral. Margin calls start in Tokyo, then London, then New York. The unwinding of the yen carry trade sends tremors across the Pacific, shaking the US economy. A strengthening yen impacts US markets. The tech sector feels the impact. Tech stocks can experience a disproportionate decline. This tightens financial conditions in the US. The unwinding of the yen carry trade isn't just about currency valuations. It's a shift in global investment flows, from high-risk stocks to the safety of bonds. Investors, spooked by volatility, turn to US Treasury bonds. Systemic risks and the fragility of global finance. The yen carry trade exposes the fragility of a global financial system built on cheap money. Events can ripple through the global network with unpredictable outcomes. When assumptions are challenged, the house of cards can collapse, leading to systemic risks. Short-term tremors, long-term questions. After the August 2024 Nikkei crash, the financial world faced uncertainty. Was this a temporary tremor or the start of a bear market? Expert opinions range from cautious optimism to alarm. The truth likely lay between these extremes. Navigating the new landscape. A world reshaped. The unwinding of the yen carry trade marked a turning point. The world that emerged was different. Risk management remained crucial. The yen carry trade was a leveraged bet. August 2024 reminded us. Understanding interconnectedness is vital. The yen carry trade's unwinding showed global reactions. This highlighted global finance's vulnerability. Adapting is essential. The carry trade endures, a game of risk and resilience. Despite the turmoil of August 2024, the yen carry trade would not disappear entirely. Like a phoenix rising from the ashes, the allure of cheap money and potential returns will attract investors, albeit with a renewed sense of caution. As long as interest rate differentials persist, the carry trade will endure, constantly evolving and occasionally turbulent. Understanding its workings remains essential for navigating global finance. What do you think about the recent developments in the yen carry trade? Will it lead to a global recession, or is this just a short-term panic? Share your thoughts in the comments below. If you found this video insightful, make sure to give it a thumbs up. And don't forget to subscribe to Trend Digest for more in-depth analysis on global financial trends. Hit the notification bell so you never miss an update.